Welcome back to Nomad Investing. Today we're going to look at a company that most investors completely ignore. In fact, many people dismiss this industry entirely. They see it as a relic of the past, an obsolete business model that doesn't belong in the modern portfolio. But while Wall Street chases the next shiny AI object, this ancient business has quietly become one of the best compounding machines in the last decade. Today we're analyzing First Cash Holdings, ticker FCFS. You might know them as just a local pawn shop, but if you look at the numbers, they are effectively the central bank for the unbanked, serving millions of customers that the big banks simply refuse to touch. The business is booming and they just posted record results. But here's the question. Is this hidden gem still a bargain, or has the secret finally gotten out, making the stock too expensive for us value hunters? Let's break down the business, the financials, the risks, and finally my intrinsic value calculation to see if it's a buy. Overview. First Cash operates over 3,000 stores across the US and Latin America. To understand why this stock wins, you have to understand that they make money in two very different ways. First, you have the normal pawn business, which is their safety net. This is simple. A customer needs cash, they bring in a gold ring or a power tool, and First Cash lends them money against it. If the customer pays it back with interest, FC makes a profit. If they don't pay it back, FC keeps the item and sells it in their store with profit. I really like this because it's counter-cyclical. When the economy is bad and inflation is high, people need more cash, and this business thrives. The key word here is business. For example, in 2008, the stock went down like everything else, but let's look at the business in 2008. It is up. So how long would you be worried if your stock price goes down in a recession, but your business revenues are up 20% in that time? Second, you have American First Finance, or AFF. This is their lease-to-own digital payment platform. It allows people with bad credit to buy furniture, tires, or appliances at other retail stores and pay over time. While this segment is growing fast, it's not yet a big part of the whole business. It's riskier and gets a lot of recurring bad debt, but these are outweighed by the good debts. Unlike a pawn loan where FC actually holds the gold ring in their vault, here they rely on the customer promising to pay. If recession hits hard, these loans could quickly go bad, but then again the pawn shop business would thrive. Financials. Now let's look at the numbers. The company has a forward EPS of around $8.6 and a forward PE of around 18. They pay a dividend of roughly $1.6, yielding 1%. They have paid a consistent dividend since 2016 and 8 years of growth. Short interest stands around 1% with the market cap of roughly $7 billion. EPS has grown from around $2 back in 2015 to nearly $7 per share TTM today. This proves that they aren't just getting bigger, they are actually becoming more profitable for shareholders over time. Regards to revenue, this company was generating around $700 million in revenue 2015. Today the number has exploded to nearly $3.5 billion, and it's a 5x increase and a 3x in revenue per share. This is driven by aggressive store openings and acquisitions. Gross margins sit at a massive 59%, largely because they buy inventory for pennies on the dollar. But don't get too excited. Net margins drop to around 8%. Why the cap? Two reasons. The massive overhead of running 3,000 plus physical stores and those recurring credit losses I mentioned. The unit economics are elite, but the high operating cost is the price to pay for their mode. Looking at their latest Q3 report, the cash flow is a beast. Cash flow from operations from the trailing 12 months was massive $577 million, or now around $12 per share. They are using this cash to open new stores, especially in Mexico, and pay a dividend. Looking at the debt, they have about $2.2 billion in net debt. However, their leverage ratio is only 1.5 times EBITDA. For a stable cash flow business like this, it seems stable. Now let's look at the future. So where does the future growth come from? The big opportunity is Latin America. The US market is saturated. You cannot put a pawn shop on every corner. But in Mexico, Guatemala and Colombia, nearly 70% of the population is unbanked. For these people, first cash is a bank. They are opening nearly 60 to 80 stores a year down there. As these economies grow, FC grows with them. There is also hidden risks in the future. Regulation. The Consumer Finance Protection Bureau is always watching this industry. FC recently had to settle for $9 million regarding Military Lending Act violations. The risk is that if the government decides to cap interest rates further or ban certain lending practices, their profits could vanish overnight. You are always one law away from a bad day in this sector. But overall, I see more opportunities than risks for this business. Valuation. Now let's figure out what the stock is actually worth. We are starting with the forward EPS of around $8.6. Now Wall Street is extremely bullish right now, estimating mid-double-digit growth. But this is where I diverge. While the economy is holding up for now, we know that the bad debt is always lurking around the corner. I'm talking about the American First Finance, AFF, their lease to own segment. I do not like the high-risk nature of this lending unit. It brings high rewards, sure, but inevitably, that credit cycle will take a hit. I am betting that they will grow steadily, but I refuse to ignore the risk of that finance division stumbling in the future. So I'm estimating a conservative 9% growth for the next 5 years and slowing down to 7% for the next 5 years. And as always, I require 12% return on my money. Historically, FC has traded between 16 to 30 PE, with the median around 22. Right now, it's sitting near 23 TTM and forward PE ratio of around 18. But because of that risky lending exposure, I want a margin of safety. I am not paying a full premium. I'm going to value this at a conservative 19 PE ratio. Even with these conservative estimates, which are significantly lower than the analysts are projecting, I get an intrinsic value of around $190 per share. First Cash is a cash flowing machine disguised as a simple pawn shop. We have a company that has grown revenue 5x in the last decade. It's dominating an untapped market in Latin America and has survived every economic crash thrown at it. Most investors look at this and see a dusty old-fashioned retailer. But the reality is, this is a financial fortress serving millions of people who have nowhere else to go. You get a business that thrives when the economy struggles, pays you a dividend to wait, and has a massive runway for the future expansion. Their riskier finance arm remains modest in size, which still helps to balance the more dependable pawn shop operations. For me, this is a buy. It offers growth, income, and most importantly, a peace of mind when the rest of the market gets shaky. But as always, this is not financial advice, and do your own research. Well, what do you think? Is FC a buy, or you don't like the business at all? Also, if you want to see another company that I think is completely misunderstood right now, check out this video right here. Thank you for watching and subscribe if you haven't already. And as always, do not lose money and safe travels.